a big impediment when you look at equity investing is the downside, and people fear that if I put my money in equities, I may lose some bit of that money. That's why you find that most of the savings of Indians is parked in traditional products. If you look at FDs, you have more than 100 crore of savings which are parked in bank deposits. So, but if you want to invest in equity mutual funds and also take part or participate in the upside potential of equities, clearly you need to have a long-term investment horizon. You cannot invest in equities for the short term.
Right.
So you need to have a long-term investment horizon. So the minimum, I would say, should be at least 5 years. So more the merrier. So you could have 10, 15, 20 years. Secondly, you need to be regular in your investments. You can use one of the avenues called SIP or systematic investment plans,
Right.
which helps you invest regularly. So if you invest regularly, what happens is that you ride over that that volatile phase.
Right.
So it provides you the benefit of something called as rupee cost averaging. So what happens here is that you buy more units when the markets are low, you buy less units when the markets are high. This is exactly what you want equities to do. Basically,
Right.
you want to buy equities when they are available cheap. You want to sell equities when they are at the peak.
Right.
But it's very difficult to time the market. So SIPs help you to ride that volatility and invest over the long run, and pick up those units at different phases of the market. And you also get the benefit of compounding because of
Right.
the longer period. So besides this, equity funds offer tax efficiencies. So you have long-term capital gains after 1 year. So the returns are tax-free.
Right.
Dividend is completely tax-free when it comes to equity-oriented funds. So these are some of the key aspects that investors need to keep in mind when they look at equity investments. So the message for investors here would be that time in the market is more important than timing the market. So you have to be in the market for a
Right.
longer period,
Absolutely.
then look at timing the market.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.